Super stressed Jay.
And then I need to record videos all day tomorrow. That's what's really stressing me out.
Jay has so many things to do. He's super stressed.
It doesn't matter where in the world you are, Jay will kill you.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 69 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson. Wait, 69? Nice. I am Kyle Wilson, Ashley Wilson's husband, and we got a great episode. We're back. We took a little hiatus, went to, where did we go? Cancun, Mexico there. We had a little hurricane we dealt with. We were a little bit disjointed, but now we're back to our regular scheduled program. How's it going, Mauricio?
Dude, I'm going first?
Yeah.
That's what she said.
You're top of the list.
I literally just got back from the last time I saw you guys. I just walked into my office, got back home about a couple hours ago, and I'm ready to rock and roll.
Let's do this. What are you drinking tonight?
I'm drinking my regular Tuesday night drink, my Camus 2020, and it's delish.
Nice. AJ, how's it going, man?
Going good. I've got my red cup with my Diet Coke fountain drink all ready to go.
It goes with your bracelet.
That it does. See, color coordinating.
That's how we know how he's voting, is by his bracelet color. It's like high school style. AJ, you got to admit, you were a little bit FOMO after seeing all of the Instagram posts and all of the fun things online that we did in Cancun, right? Like you missed us a little bit.
I missed you guys. FOMO, not at all. But you guys, yes. I wish I was there hanging out with you guys, but not at the event. I was so busy. But I'm sad that I missed all three of you guys at the event. That looked like you guys were having.
Were you as busy as Jay is busy right now?
No one's ever been as busy as Jay is right now.
Jay is so busy, so stressed, so angry at me right now for making fun of him being stressed. I don't even know if he's going to be able to get a drink in him right now. Look at him. He's just like, you can literally see the steam coming out of his ears.
I'm not going to lie. I'm a little bit stressed. It's not you. It's me. I lost internet today. I went through 2 hurricanes without losing internet. And then today, for no apparent reason, I lost internet. And we record this at 7:00 at night. I have another live event after this at 9:00 that goes till 11. And so I wasn't happy about having to ask a good friend of mine if I could just come and invade their house for like all night.
And the beauty about your internet being lost, it has nothing to do with the hurricanes.
Had nothing to do with the hurricane.
I'm sure it was residual. What are you drinking?
I brought a bottle with me to my friend's house, a bottle of the Circumference Cab, my Costco special. And
thanks for holding that up to the camera there with the dim lighting. We couldn't see shit. So, all right. Well, I am going to try something new tonight. First of all, I'm doing great. I had a great time. The Eagles won on Sunday.
You're going to moderate?
Yes, I'm going to moderate. That's good. I'm going to try this. I'm going to try drinking scotch. Actually, my mom is a scotch drinker, and they just came to visit to watch my kids. Shout out to my parents. So in honor of my mom, I'm going to try this Monkey Shoulder. Apparently it's a really good scotch. It's a cool bottle. It's got like some monkeys on it.
So we're dedicating episode 69 to your mom?
In hindsight, that was, yeah. Damn it. Okay, we're just going to move past that one. And we're going to go on to Jay's economic update.
Jay's
on fire. I deserve that. I was giving him a lot of shit before this, and he got me back. I'll give you that. Okay, let's get into this. Just when we thought we had it all figured out 2 weeks ago, our last economic update, we had just received a 50 BIP cut with more predicted to be coming. 10-year treasury was heading down. We thought we were going to maybe hit 3.5. And it just seems like we can't have nice things. I just checked, the 10-year treasury is almost pushing 4.1. Marcus still believes we have 2 more cuts coming this year. So, Jay, is this just because of the most recent jobs and inflation releases, or what's happening right now?
Yeah, let me start this off by pissing off everybody that's listening, but I'm going to do it. I am officially declaring an inflation soft landing. So I know that pisses people off. And hear me out. I'm not saying.
What does that mean? What exactly does that mean? An inflation soft landing?
We killed inflation without a recession.
We did. And so just to clarify, before anybody starts beating me up in the comments, I'm not saying prices have come down. I'm not saying prices aren't still absolutely ridiculously high. They are, and they're not going to come down. I mean, that's just the way inflation works. But by the definition of inflation, which is how much prices are continuing to go up at this point in time, we're pretty much right where the government wants us to be according to their numbers. And we were able to get there without a recession. We were able to get there without any major economic turmoil. I mean, I guess that's debatable. But for the most part, the Fed was able to achieve a soft landing with inflation. So last week we had CPI and PPI release. CPI is kind of the consumer price index. That's how much consumer goods and services are going up or down in value. And PPI is kind of the wholesale cost, what businesses are paying. And what we saw was, from a CPI perspective, it was a little bit higher than expected, but the expected number was lower than the Fed target. And so for the year, we dropped to 2.4%. Reasonable number. Fed wants us to be around 2%, but if you look like the trailing 6 months, we actually are at about 2%, maybe even a little bit less. So CPI number was good, and then the PPI number came in lower than expected, or where it was expected, which was lower than the target, meaning that businesses are paying a reasonable amount. They're seeing a reasonable amount of inflation for the goods and services that they're buying. And so for the most part, I mean, the Fed has accomplished exactly what it set out to accomplish. Again, prices haven't come down. Everything's gone up a good 10, 15, 25% over the last couple of years. And that's not going to change. But moving forward, we're in a position where the economy can kind of start to get back on track, at least from an inflation perspective.
And those, just to be clear, those are fighting words because you're going against the market indicators, right? If you look at some of the market participants, like those in the gold market, for example, I mean, gold typically goes up when there's an inflation expectation. So we got gold that's been going up all-time highs. I mean, it's literally up 30% over the last, year or something. It's been kind of crazy. And then the last, ever since actually the Fed funds cut, it's been going through the roof. Like I said, all-time high, I think it's at 2650 or something, somewhere around there. And then the 10-year, which is also sort of an inflation expectation number, that's also gone up, which has really thrown some people off because they were expecting that to go down as the Fed funds gets cut. They were sort of expecting a correlation of the 10-year to go down and therefore mortgage rates to go down. And that's the opposite has actually happened. So you're betting against the market, Jay.
Well, let's start with gold. Gold isn't necessarily an indication of inflation fears. It's an indication of economic fears in general. And there's still a lot of fear out there. We've gotten an election coming up that a lot of people are concerned about, like on both sides, who wins. We're still concerned about prices being too high. We're concerned about jobs. We're concerned about the fact that we're living in what we referred to a couple of weeks ago as the shit sandwich economy, where those at the top are doing well. Those at the very bottom are kind of making a little bit more. Those in the middle are getting crushed. And so there are a lot of bad things in the economy, and there's a lot of risks in the economy. And this potentially is impacting gold prices. People are fleeing to gold for safety. In terms of the 10-year and bonds in general, well, I think there's a lot going on there. One, we saw a de-inversion for the first time in 27 months. First time since July of 2022 that the yield curve de-inverted. And so I think things are normalizing there. And so I don't think that the 10-year going up is necessarily an indication of economic issues. But on the other hand, we've gotten some decent news on both jobs and inflation over the last couple of weeks. And when you get decent news, I mean, basically that's saying the market is pricing in less chance of a future rate cut by the Fed. And when you have less chance of a future rate cut by the Fed, you're going to see the 10-year, you're going to see the long end of the curve tend to drift.
Well, the news cycle is saying the jobs are good news, but I've been hearing the opposite on inflation. People are saying that this last inflation report, the last PPI report, they're both higher than expected. That combined with the jobs, we're going to see all of a sudden there's a chance that inflation's coming back. It's going to roar back up. It's going to be the 70s all over again.
Well, Mauricio certainly was saying that. Mauricio's been saying that for over a year now.
Yeah, not the 70s, but I've always harping back to the 1940s because I think that's a little bit more similar to what was going on now. But I've been talking this for a couple of years where I didn't expect a straight line up, and I'm not expecting a straight line down. We may even get to negative. I mean, in the 1940s, we actually went negative we literally had deflation, went below 0% for a little bit, then spiked right back up above the prior high, which is why I'm kind of interested in seeing whether we're going to hit that. I think we have a bet going on, Jay. I forget what we bet or how long ago, but literally whether inflation was going to approach the prior highs of a couple of years ago before the end of the decade. I mean, we still got 6 years, but I anticipate inflation going up and down throughout the decade. I don't necessarily think that this is it. And now we're suddenly going to be at that 2 to 2.5% range for the next foreseeable future. AJ, what do you think?
I've been saying that too, and I agree. I think that inflation is it is much easier at this point for it to go up than it is to go down because it has to do with how money moves. It's really easy to inject $4 trillion into the economy. It's not easy to get it out. And because you've slowed the rate of money doesn't mean that lowering interest rates won't increase that. And when you start spending and leveraging, it adds to inflation quicker than you can. It's not leveraged when it's coming out like that. So it's easy to get sideline money moving, and where inflation has been, and where the jobs are, we're much more sensitive to it. So the overall capital that's in the market, that's in funds, that's in everywhere, there's a lot of it still. Asset prices are high. We have equity. So if interest rates dropped and people started to use all that capital, all that equity, they started to borrow, we would explode so quickly. So I think we're at a point where it's way easier to get inflation to spike up than it is to keep it down. And I think that is what the Fed's looking at. And I think it can be easily set off. So I don't think, because we haven't had a contraction, we haven't had restructuring. So none of those things that have happened that would create sustainable deflation and deflationary effects, we haven't had them. So I feel like we still could be a tinderbox. And I think they're trying to move through this very carefully, where they're trying not to let it get to that point. But I don't think we're out of the woods. I don't think it's clear. No.
I also want to, I don't want to say I want to correct Jay, because, there's definitely a sort of a new wave and an old wave. And it's always dangerous when I try and correct Jay. But something you said, AJ, which I think is important in terms of where the money's been moving. The classical definition of inflation is not the rising and coming down of prices. It's the increase in the money supply, and the increase in the money supply as that money supply inflates generally causes prices to go up. But inflation in and of itself is the increase in money supply, and so that happened. There's no denying that. And to AJ's point, that money, that liquidity has not been sucked out of the market. It's just kind of moving different places. It's stagnant. So the prices can still go up and down until we can get that money out of the system, that liquidity out of the system. To AJ's point, that money can start moving into certain places, and you can certainly have a tinderbox and have prices go back up again. But I think it is important.
Shelter makes up 1/3 of the number. Shelter makes up 1/3. So what happens when interest rates go down and everybody wants to buy houses and everybody's building again and cost to build all that goes up again? That's 1/3 of the inflation rate.
Well, but that's not how they get shelter, right, AJ? They don't even care about those costs. They just go around and they ask people, hey, if you were to rent your house right now, how much do you think you would rent your house for? And if that goes up, then therefore the cost of housing goes up.
But when you don't have people moving and you don't have people buying, when you don't have things happening, the cost isn't rising because we don't have inventory. So all of a sudden, if cost of housing goes up and I have to pay, then I have to charge more for rent. It's an inflationary effect. The way you get those prices to go down, if you increase demand for it overall, the cost will rise. Therefore, that gets transferred to renters. But if we want it to go down, we have to have supply, which we don't have. So any change within that interest rate that is going to drive more buyers will affect prices in an inflationary way.
Or they could just figure out how they've been doing this, where they can lower interest rates and then therefore cause the 10-year treasury to go up, which will increase mortgage rates. And so by lowering interest rates, they'll increase mortgage rates, which will decrease demand for housing, which, then everybody wins. So apparently they've just figured out the formula in order to lower interest rates and keep demand.
The yield's going up, the 10-year is going because of elections. And so I bet you after elections, once things calm down, unless we have riots or everything else again,
So
I
you,
bet you
so you think the 10-year is just because of the election? Because I assume, like, usually when you look at the 10-year, you could look at the forward curve, right? And you could say, like, okay, see some sort of correlation. But like, if you go look at the FOMC, like the predictability odds, like we are still like 90% chance next time of a cut, and like 90% chance of a second cut, the one after that. So it's still two more cuts, which isn't really a change from what it was before. And yet we went from like 4 points or 3.6 up to almost 4.1. So like usually those two things you can kind of see some correlation, and I haven't seen it.
But I think that's a myth, though. I mean, I showed the graph. I've got it up if you want it. But if you look at the graph of the Fed funds rate and overlaid on the 30-year the 30-year mortgage, I think it is. I mean, in the short term, you can clearly see the mortgage rates going up as the Fed funds rate gets.
But Mauricio, I'm talking about the curve though. Like if you look at the SOFR curve, you could pick your curve, but like obviously we look at the 30-day SOFR is us for commercial real estate, and so that's kind of a prediction of where they believe interest rates will be long term, and it will go out 10 years, and you can kind of just look at, okay, where's that curve going to end up and where is it now, and that's kind of a pretty good predictor typically of where, since we're high and we're going back down low, and then okay, what's the average of the 10 years? It's a pretty good predictor of what the 10-year treasury should be. And that the SOFR curve, like nothing really changed in the short term as far as how quickly we were going to go down. I'm just saying over like the last 2 weeks, nothing really changed how quickly we were going to go down. But somehow like the long end of the curve, just like people kind of skipped over that and went to the long end, and they decided that we were going to be higher.
So I kind of disagree. I mean, over the last couple of weeks, and this is anecdotal, I mean, but people I've spoken with 2 weeks ago when there was a 50 basis point cut, basically the consensus was at the next meeting, which is 2 days after the election, we're going to see another 50 basis point cut. We'll probably see another cut in December. So we'll probably see another 75 basis points before the end of the year. That's no longer the sentiment that I'm hearing. And don't get me wrong. I mean, the market is certainly pricing in another cut. Here, I can bring up the market prediction here. The market's definitely pricing in another cut, but we're not pricing in multiple cuts. Or larger than a 25 basis point cut in the next one. We're not necessarily. I mean, there's zero chance, according to the market, that we're going to see 75 basis points before the end of the year. So we're not really seeing the same level of cuts that people were presuming that we were going to get immediately after the meeting 2 weeks ago. And I think that change in sentiment is likely what's driving the 10-year up. The other thing to keep in mind, and Mauricio points this out all the time, is that the 10-year is a good reflection of where people think the economy is going in the next 5 or 10 years, where inflation is heading over the next 5 or 10 years, because it's representing basically people making a bet on that term of bond. And so I don't think it's unreasonable to be concerned about inflation over the next several years. I mean, we've talked about this before. Regardless of who gets elected this election cycle, neither candidate is talking about cutting spending. So it's likely we're going to see massive deficits over the next 4 years unless something changes. If you look at the economic plans of both candidates, we've got tariffs on one side, we've got massive regulation on the other side. So we're likely not to see much good in terms of economic progress over the next couple of years unless somebody changes their plan. And so, yeah, I think I'm saying I think we're at a point where the inflation numbers look really good for right now, but I don't necessarily expect it to stay that way. One last thing I'm going to add, and Mauricio, you're 100% right, that when we use the term inflation, up until a few years ago, that always meant the increase in the money supply. But a weird thing happened after 2008. We printed $8 trillion after 2008. We had massive QE for the first time. And I think everybody expected that just like after COVID, we were going to see massive inflation after 2008 because we increased the money supply. The reality was we saw really low, like less than the 2% target inflation during basically the 8 or 9 years after 2008, after the recovery from 2008. And so we've kind of stopped assuming that money printing has to lead to inflation. Obviously, there's a whole lot of factors that play into it. But I think it was after 2008 that we kind of decoupled the term inflation from just the increase in the money supply and started applying it to the increase in prices. But yeah, you're absolutely right that that's the classical definition. And by that definition, we're going to see massive inflation no matter what happens over the next couple of years, just because both sides are likely to keep printing like crazy.
Well, I created I'm trying to get this here so I can show you guys, because what I did is I was looking at the effects of inflation on the overall change in the 10-year. And when you look at it, it's almost exact. So when you look at over time, the inflation rate and the 10-year rate will change, and they will go like this as far as the percentage of change. So if the market expects there to be inflation, it will rise. And so when you have those two things overlaid, which, come on, I'm trying to get this up here, but might take me a minute. You have those things overlaid, you can see how those two relate and correspond. And they move together. So that 10-year changes in that short term with the expectations of inflation. And that is what I was thinking really strange with this current rise. Now, of course, it's other things, but there is this core relationship between the two where these two things are driven. So it's not that the 10-year will rise, right, and inflation rise. It is the percentage of change that they take on. And that is fascinating to look at how those two things really work together. I don't currently, I don't have it. I don't have it up, but I'll try to get that up so I can show you guys, because it's really fascinating. But I think that the market may be looking at and wondering too, as we just have talked about, if this is going to create inflation. And so the short term, they're expecting more inflation. And so we see those rise.
So I guess the question everyone's asking though is, are we going to have some reprieve, right? As real estate investors, like every time something happens here, we're like 10-year treasury drops a little bit and we're like, oh, this is it. Like we're going, it's going to be green light. Here we go. And then something else just happens 2 weeks later and then kind of just puts the brakes on it. So like, what is it going to take? Because we thought it was going to be that rate cut, and then not only did we get a rate cut, we got a 50 bip rate cut. So like a lot of people were saying, okay, here we go, green light, and that didn't happen. So what is it that it's going to take for us to get that green light that, okay, it's risk on for real estate investors?
I think we're going to need to see some long-term indication that that inflation and the economy are under control. And I mean, we talked on this podcast before that rate cut. We predicted that mortgage rates weren't going to respond to the rate cut, and if anything, they might go up. And so I don't think anybody here is surprised that happened. Longer term, I think it's just going to be a normalization of the yield curve, which we're starting to move in that direction. Unfortunately, normalization of the yield curve often means we're heading towards recession. Hopefully it doesn't in this case, but I think that's going to be part of it. I think some indication that inflation is quashed long term, that's not going to return. And then some indication that But
what is that indication though? Because like so the Fed uses core PCE for their indicator, and we've been under 3% for 6 months.
So again, let's go back to the
Our jobs are stable right now. Our GDP has been good. Like what's this indication? Like you say, like we need some indication of all these things. Like every single indicator's there.
Yeah,
I don't get it.
Except consumer confidence. We still have this major disconnect between the data and what people are thinking and feeling and saying. And ultimately, it's sentiment that's going to drive yields. Sentiment is going to drive risk premiums. And Mauricio is going to...
So can we just get Russia, or even better, let's get China and on some TikTok algorithms, and let's drive consumer sentiment and just start saying, hey, everything's great, everything's fine, everyone please start investing, and TikTok will just convince us all and we'll be fine, right?
And then we'll be called the deep state.
But let me give you, maybe this is an unpopular take, but you mentioned, Kyle, that what is it going to take for there to be a reprieve, right? And it's like, well, why should there be a reprieve? I mean, this is our historical averages that we've been having. We've just been spoiled over the last 20 years since the great financial crisis, because the Fed did go to 0%, which is, has never happened in the history before. But I just pulled up the average or medium mortgage rates in the 1990s, 7.88%. Medium mortgage rates in the 2000s, 6.18%. It wasn't until 2010 in that decade where it started to go down. That's just because the Fed had this playbook of going down to zero. So if you talk to the old timers, right, the guys have been around for way longer than all of us combined, except for maybe Jay. They're used to this. This is their normal stuff. They remember when they were investing back in, prior to the great financial crisis, and they're used to having interest rates at 7, 8, 9%. Like I
guess I'm more just like talking about like ease of doing business, like something like banks. Like a very good indicator is bank spreads, right? Like bank spreads are still very high right now. It has nothing to do with the actual, I shouldn't say nothing, but like a lot of what the high rates have to do is actually the spreads. Like these spreads could be coming down to, 150, 175, and they're not. So like
it has everything to do with inflation. So the jobs report came out. Jobs were strong. Economic growth is strong. Then they're lowering rates. Once again, the percentage and change in the trend line, especially with those 10-year yields, follows that so closely. The market, after receiving really strong economic information, earnings information, consumers are spending, and then saw that jobs were strong, we're not getting job loss, and then you're talking about we're going to lower interest rates, that equals inflation. So it's the inflation numbers are not coming, they're plateauing, right? We're right there. It's not that it's not bad. This is a forward projection that the market is stating on this 10 years, because it happened right after the economic numbers that moved it were the job numbers, right? And then the earning reports. Consumers are strong. Jobs, earnings, we're getting higher incomes. There's more jobs out there. It's a competitive landscape. Then you start lowering interest rates. Well, why in the world would inflation go down? So that's what's making these spike. If you came out and you had a jobs number where it was like, nope, job number were negative, earnings report, consumers are down, they're not spending as much, that 10-year would not have gone up like that. We would not have seen these increases. And so I think that's the driving reason.
Let me add one more complexity to this. When we talk about inflation, whether it's PCE or CPI or PPI, all these different measures of inflation, remember, we're talking about a basket of goods. And so we're talking about like a whole bunch of different things, and they don't all move together. So if you look at last month, what you'll see is food went up a lot. Food went up like 5% annualized last month. On the other hand,
but eggs went down dramatically.
Jesus, I knew what you were saying. The moment he said basket of goods, I'm like, fucking Mauricio is he's just waiting to bring up eggs right now.
So let's talk about eggs.
Nice. All right, now we're talking. Let's go.
So
organic or regular?
I think it's grade A large eggs.
But is it free? I mean, are we talking free range, organic, pasteurized, or are we talking like they're all in some caged up, commercial?
These are just straight from AJ's backyard eggs. That's how much he's able to charge.
So what we see right now is that eggs are actually very expensive. The most expensive they've been, other than that peak at the beginning of 2023. But this isn't necessarily due to inflation. There have been some bird flus going around. A lot of birds have been slaughtered. Eggs have been lost.
That's a conspiracy theory. Don't spread around the conspiracy theory.
Do the birds have COVID now? Have they gotten their shots?
Anyway, so food went up a lot last month. Energy actually went down a whole lot last month. So from a sentiment standpoint, yeah, we've got some bad news with food, but people care a lot about their gas costs and their fuel costs, especially as we're heading into winter, especially as we're dealing with hurricanes in parts of the country. And so it's not all necessarily the news is mixed, and so I think you have to dig into the data to really get an idea of when we talk about inflation going in one direction or another. What are the specific goods and services? If you look at the PPI, goods were down a whole lot, services were up. And so you could argue that that's a good thing because businesses pass on the cost of goods more so than they pass on the cost of services. And so it's possible that the PPI broken out the way it is actually better news than if you just look at it as a single number.
So I threw this chart up here, which shows the percentage and change in interest rates and inflation rates in the 10-year. And you can kind of see how they track each other in the market and what it thinks and does. And so if you look at what's moving those things, there's obviously others. This isn't it went up 3 points, right? It's talking about the percentage and change and the relationship that percentage and change has over that period. Went up this way, went up that, right? But they're correlated. And that's the whole point. As in the market and that 10-year movement is very correlated to the inflation in the change, right? Obviously, inflation will go up and it will keep going up. It doesn't mean it goes down, but the percentage in that market day or whatnot, it changes and they're very much correlated. And so I don't know what the long term on the 10 years and everything, even though the Fed's saying they're dropping interest rate and spike, right? Once again, I think it's a direct correlation to that. And it'll be really interesting now over the next week or two, especially whatever we have coming up, if we see that change and goes back down, if the market's like, oh no, we're not going to get it, and it'll hedge.
Well, I hope we get something going because I'm going to throw up one more graph too, just to show. So, because Mauricio was talking about like, oh, the old timers historically, oh, these rates are this high or whatever. But if you look at it from this perspective, what I have here for people who are listening is I have the mortgage spread over time. So that's the spread over whatever you could take it from the 10-year treasury or the SOFR rate or whatever. And if you look at the mortgage spread over time, we got, and it goes back to 1990. We are at historic highs from 1990. We went higher than even the great financial crisis back in 2008.
So I don't have any data in front of me, but I believe looking at this, each of these spikes, the one before 2000, the one before 2008, the one before 2019, and now, all correlated to yield curve inversions.
That would make sense. But I guess my point is that we're higher than we've ever been.
Yeah, but I'll take your mortgage spread over time, and I'm gonna get rid of that. Let me show you my graph, which is way more simpler, requires a much lower.
We would love to see something that's more simpler.
This is the historical mortgage rate chart from going all the way back to 1971. And as you can see, the median is 7.37. What are we at today, Kyle, give or take?
See, Mauricio, anyone could just pick any time frame that they want and pick a trend where the line is in the middle.
You just picked from 1990. You just went back to 1990. I'm going all the way back to 1971.
Take the spike out from the 80s there, where it goes up to 18%, and then
take it out. But even if you take it out, you're still seeing that even before the spike, the low end of the curve here was way above 8. It was like at 9% even before that.
We talked about this. This is prior. That was back before we had a 130% of debt to GDP at this point. Like we are in a low interest rate environment. We're never going to see high interest rates up to 18% or anything like that again, because it would tank our economy. But you know what else is unprecedented was the Fed going out at zero. They'd never done that playbook before, and now unless it goes back to zero, which by the way, I'm not saying it won't. I am not saying by any means that if we don't have some financial crisis that's at the level or even close to the level we did in 2008, that they won't go to that playbook. But unless that happens, why would you expect rates to go back down to anywhere near below those medians? Because there's always going to be a crisis, Mauricio. And as you said, that's now in the playbook. So it's going to be part of the playbook. So I would argue we are starting a new trend of historical highs where people are going to start the charts back where we are right now. And this is going to be highs. Anyway, Jay's giving me the classic, let's hurry up. he's the only one on this podcast where he's like, let's hurry up. I've never seen AJ say, let's hurry up. AJ is just happy hanging out.
I think about our listeners who are done with this topic.
Well, he worries about the listeners after Jay's gone on for like an hour on his economic update.
As soon as Jay's done talking, wrap it up.
Wrap it up. I'm done with everything I've got to say. So let's go. Let's move on.
We can't get too mad at Jay because poor Jay over here was hit by 2 hurricanes in 1 month span. But luckily, he came out relatively unscathed. And this is not true, though, for many homeowners and investors across the state of Florida. So we can give Jay shit, but it's just because we're happy that he's okay. But there are projected total losses upwards of $100 billion. I feel this is like Dr. Evil levels for these 2 hurricanes. And historically, after major destructive events, there was a major push to rebuild, and investor capital has flooded into the area. But Mauricio, how do you think the real estate landscape is going to look at Florida after these 2 major storms? With insurance rates were already pretty high, weren't they?
Yeah, that's what I was thinking about when I wanted to present this topic, because I just had to think, like, we've already talked about all the issues that Florida's had even before these hurricanes. And I'm just curious. I was curious to find out whether this is going to make things even worse, almost make it like a California. I know we're talking specifically about Florida, but we're really talking about any of these states that have some of these issues. I mean, California for other reasons, but look, we've had some of the most, I mean, I think it wasn't as bad as we expected, but still pretty devastating hurricanes, right? I think Hurricane Milton already has estimated to be about at least $36 billion in insurance payouts. We've got some other Fitch is reporting between $30 and $50 billion in damages that are going to have to be paid. Obviously, lives are lost, which is probably the most important part. I think about 100 people have died. 100 people are missing already between these 2. But like, to your point, even before this happened, we had these major issues in Florida where we already had skyrocketing prices, right? And that was a lot to do with all this population growth, right? The last I saw, there was about 350 to 375,000 people moving to Florida every single year. And that's been a trend for the last decade, only exacerbated by COVID, right? So you've got these skyrocketing prices in Florida already. I think I've already heard anecdotal evidence of people are finding Florida already too expensive and starting to look at other markets like North or South Carolina or Tennessee because prices have already gone too high. We've got soaring property taxes, which obviously hurts on the investor side. That affects your expense ratios. We got the international buyers. We talked a little bit about that a couple episodes ago again, but a lot of the international buyers tend to focus on bigger markets like Florida, Texas, and California. So just in general, we're having those issues. And then specifically with these hurricanes, I mean, I think Newsweek, I saw an article in Newsweek that says that the average homeowner now before the hurricanes was $11,163 per year for the average homeowner insurance. And that's up from about $2,500 in 2019. And the issue is, as we've talked about before, is a lot of these, I'm not saying a lot, I'd say the majority of these insurance agents have just left the state. They're leaving the state because the math just doesn't end up. And this is not meant to be a masterclass on how insurance works, but clearly it's not working without the insurance company being able to charge much, much higher premiums, which either the government doesn't allow or the people just don't.
Well, Jay, correct me if I'm wrong, that the Florida has a state-run property insurance company, right? And they are now.
Can I get to that? I'm about to get to that. You want to interrupt me when I'm about to get to that state-run insurance thing, and you just interrupted me. Somehow we haven't heard enough from Jay that we want to go back to Jay to talk about
the only point I was going to make is they are now the largest insurer in the state. So you're talking about all these other ones. They're the largest one in the state.
Do you know why?
Well, you were just explaining it.
That's right. Until I was interrupted by my brilliant explanation, I was about to get into why we have this issue, which is because of the exodus. In fact, CNN just reported that they had this exodus. So it's Citizens Property Insurance Company. This is a nonprofit state-run insurance company that basically, number one, is the insurance company of last resort. There's about 1.3 million people that are insured through Citizens. And the governor, DeSantis, already had come out before these hurricanes that basically said this company is insolvent, that we do not have enough there to cover anything major. And this was before having these two hurricanes. So this is just an issue where if you're looking to invest in Florida, even before the hurricane, you had these issues of real higher prices, higher expense ratios. Your NOI is going down. Your cap rates are going down. I'm sorry, are going up. Sorry, your cap rates are going up. And then the last thing I wanted to point out, which I thought, again, talking about some unintended consequences, this is on the legal side. So I got really excited when I saw something legal related here, of course. But they literally had repealed December of 2022 in order to try and keep these insurance companies that are just exiting the state. They repealed a law, which was the one-way attorney fee law, which allowed homeowners to recover legal fees if they sued an insurance company and won. They repeal that in order to appease more and more insurance companies to stay. It's almost like the contingency fee in a personal injury, right? So it makes it easier for you to sue somebody because if you win, you don't have to pay your attorney. That got repealed. So now we're in a situation where if you end up suing your insurance company and you settle or you don't actually get a judgment, you're not going to be guaranteed to get your attorney fees paid for, which is, again, a huge disincentive for somebody to go after people in the state. So anyway,
Can I throw a stat on that, Mauricio? That was I found super interesting.
What was that?
I'm just going to throw a stat on that for Florida, which I found super interesting. So 9% of all homeowners insurance claims in the U.S. are come from Florida. Okay, 9%. But then it's 79% of all national lawsuits over claims filed come from Florida. So only 9% of the claims filed are from Florida, but 79% of the lawsuits are from Florida.
Yeah, and that just goes to show that here's kind of my thesis on this, and I'm interested in seeing your guys, but it sounds like the cost of doing business in Florida is just going through the roof. It's getting worse and worse, where it's getting to the point where it's almost like, well, why would you invest in Florida? One of the things that doesn't show up in the stats, yes, insurance is going up, but even when your insurance covers you for whatever, you have these like periods. If you buy an investment property in Florida, it gets devastated by a hurricane. And even if you do have some sort of insurance, unless you have some kind of a loss rent insurance, which very few have, you're also just out of commission here for the next 6 months to a year as you're rebuilding your home. So it seems to me like the cost of doing business in Florida is, although different reasons, very similar to the cost of doing business in California. Why in the world would you invest in Florida when there's other places that your money will go a little bit further? You guys are the investors in the group, so you tell me why somebody would, especially after these two hurricanes, would want to go to Florida.
I'll let Jay and AJ answer this, but I just want to point out that all of our properties have loss rent insurance. Just throwing it out there.
Even for hurricane and flood.
Yep, for sure. You'd be out of business, I think, if you didn't.
Okay, let me start with the conclusion. I am selling all of my Florida properties, and I believe that owning property in Florida at current market rates is untenable. I think values for Florida real estate have to drop over the next couple of years. Literally a third of my head is filled up with data around this. That's all I've been looking at for the last week, it feels like. So starting with the conclusion, I'm selling everything I have in Florida. We don't own any multifamily in Florida, but I'm selling all my single family in Florida, and I expect prices to drop precipitously over the next couple of years. Let's digging a little deeper. Here's something that a lot of people don't think about when they think about Florida, but is kind of an important point. We don't have income tax. There's no state income tax in Florida. The bulk of our money comes from two sources. One, it comes from tourist revenue, but the vast majority of government revenue in the Florida market comes from property taxes. And so the government has a very large vested interest in ensuring that property values go up, stay up, and don't go down. Because when property values drop, property taxes drop, government revenue drops, and government looks bad. And government doesn't like to look bad. So the government will do whatever they can to ensure that property values stay propped up. Here's the problem. Given the numbers, and we can go into the numbers if you guys want to go into the numbers, but given the numbers, we're basically in one of two situations. One, either the state government and the federal government are going to have to inject massive subsidies into the Florida property insurance industry to ensure that property values stay afloat. Basically, they're going to have to subsidize people's property insurance so it doesn't get so expensive that everybody moves out of the state or starts selling their properties for a lot lower values because insurance is so high. So either we see massive government subsidies at the state level and the federal level, or we let market forces play out and we let insurance companies come back and charge whatever insurance companies need to charge. And we see insurance prices go through the roof, in which case values are going to drop. And so the question becomes, which one is more likely? Are we going to see massive subsidies by the state and federal government, or are we going to see market forces jump in? Consider that if we see massive subsidies by the state and local and federal government, that means, are we also going to see massive subsidies in the Louisiana market, in the Texas market, California with wildfires?
Why would the feds get involved in the Florida real estate market? Like, I understand Florida wanting to subsidize. Why would the feds do that?
They already do through FEMA.
Oh, the $700?
So there are about 5 million FEMA flood policies in the U.S. right now. And FEMA lost $20 billion last year paying out these flood insurance policies. Well, moving forward, I think it's safe to say that these storms are going to get more frequent and they're going to get stronger, and FEMA is going to take a much bigger hit. So is the government going to continue to subsidize? I mean, FEMA tried to raise prices back in 2020, and they got sued by 10 states that basically said, no, you can't raise prices. We need you to continue to subsidize these flood policies because otherwise we're going to be screwed. And the Justice Department basically said, yeah, we're going to have to keep these flood policies cheap. And so there's been a ton of federal subsidy for things like FEMA and hurricane response and hurricane cleanup and all of these things. And so that's either going to have to increase at a massive, massive rate, like to the tune of hundreds of billions or even trillions of dollars, or we're going to have to let market forces play out, in which case we're going to see prices and values in Florida plummet.
But my point, Jay, I guess the question, you being the local resident, and we're all super glad that, Milton didn't do as much damage as we thought it was, and you're safe. But like, even if properties did go down 20, 30%, which I don't know if they're going to go down that much, is it even worth it at that point? I mean, there's so many issues with Florida now, with the insurance, with the hurricane, with all of it. Is it really something that you want to get involved with? Just like you would say in California, like why do you want to get investment in California with all that's a regulatory issue, but why would you invest in Florida even if prices went down?
It's true. And here's the other thing that I didn't mention, that even if we do get massive subsidy, or even if we do have market forces, there's another issue that we don't really talk about. And that's the fact that we all know that a lot of insurers have left Florida over the last couple years. And you mentioned Citizens. Citizens is the statewide insurer of last resort. Citizens was insuring 400,000 properties back in 2020. As you mentioned, Mauricio, it was actually a few months ago, it got up to about 1.4 million. Basically, what the state has said is you need to get rid of some of these policies. You need to start kicking some of these policies over to private insurers. And so now I think they're down to about 1 million policies. And in the next few months, they're trying to get back down to 400,000 policies. So basically, Citizens, this insurer of last resort, is saying to 1 million policyholders, you need to go find a private carrier, and we'll help you find a private carrier that will insure you instead of us. Here's the problem. All the big carriers have left Florida. All the carriers that can afford to be in Florida are now out of Florida. Who's left in Florida? A whole bunch of really small carriers that are here for one purpose: arbitrage. They're coming in and hoping in a very short period of time they can collect massive premiums and then get out before there are any major storms. Well, exactly. Oops. They already haven't accomplished that. And so what we're seeing is that the insurers that are left here are basically insolvent. And so there's a reinsurance fund in Florida, but the reinsurance fund has, I think, something like $10 billion in it. So once that's depleted, basically there's nothing left, and policies or claims just stop getting paid, and Florida property insurance becomes insolvent.
Yeah, and this is one of my biggest. You've been hearing me for years talk about harping on my issues with insurance, but my biggest beef with insurance companies, this is someone as a perfect example, is that people think they're insured, right? They're making their monthly policy premiums and they think they're covered. I just saw an article in one of the mainstream media companies where somebody's making their premiums, But you know what? They didn't realize that even though they thought they were insured because they had quote unquote hurricane insurance, they didn't realize that it only covered wind damage. It didn't include, the storm surge, the water damage, which is what a lot of this happens. So thinking they're insured, they're not. Or in the example you just gave, Jay, companies are insolvent. So they're making premium payments to these companies. And then when it's time to collect, they're not around and there's not enough money to go around. I mean, this is why insurance is not the end all be all, even though people like to think, hey, I'm insured, I'm good.
Can I make AJ's head explode? Do you know what a solution to this that I've been hearing start to be kicked around? Obamacare for home insurance. So basically, they'll think about Obamacare, like it was a fractured insurance market for healthcare. It was needing reform. And so that's where Obamacare was this sweeping reform for health insurance that provided health insurance to everybody, regardless of pre-existing conditions, yada, 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 yada. Is that not a similar situation as to what is happening right now across multiple states where insurance is not available, unaffordable for millions of Americans, and we need sweeping reform nationwide?
Well, there's a lot that can be said about that. So, first of all, if we want to go in, the premiums have only gone up, in fact, escalated under Obamacare. So premiums with the subsidies have all risen. There's been not only no relief on health insurance from the act, they have gone up and they escalated. So probably not a good example to use.
But it is a good example because that's how subsidies work. The trade-off is some people or most people pay more money, but you have more people that are covered in a catastrophic situation. More people have catastrophic health insurance now than at any point in history. And so if the goal is cheap health insurance, that's one thing. But if the stated goal is to have as many people covered, that's a different thing. And those two things are at odds. And you need to decide.
But they said that that's what it was supposed to do. It was supposed to lower. They used, if we add more people into the health pool, our health insurance cost will go down. That was how they got it sold. That's how
we're accepting that it's going to cost more forever. Like it's already happening. Like if you look at Arizona right now,
if you just want to charge people for it, then just charge them.
Well, but it's already happening. Like if you look at a place like Arizona, the home insurance costs went up 30% over the last 3 years. Has Arizona been hit with like an unprecedented amount of hurricanes or natural disasters or anything like that? No, like they've kind of just had the same thing happen, and in like their insurance costs have gone up 30% because it's like the same insurance companies are insuring in Florida and Texas as they are in Arizona, and they got to make up their costs. So instead of jack up 300% in Florida, they're going to do 200%, and they're going to jack up an extra 10% in Arizona. It's already happening. It's just like as Jay said, like something's going to happen. I don't like in this new American economy and politics and everything. I don't see them just allowing Florida real estate to just tank. So they're going to come up with one solution. And I'm just saying this is already a solution that was implemented on a very similar situation. And I don't think it's I don't know much. I would say it's not similar at all, because with health insurance, you're dealing with your health, and there's, it is what it is. In Florida, you can just move, right? You can, if you don't like the prices, it's too expensive or it's too dangerous, just like California, you can move. You can move.
You can move into Orlando, get away from the coasts, everything else. And two, not only that, you're also dealing with, for the health insurance and health insurance premiums and what they cover. It is so convoluted and it is so regulated. It's a wild thing. And two, the Affordable Health Care Act, right, that took on people that didn't have insurance, which most of them already qualified under all the other programs that we had available. And so it was really more of like they need to put into place, okay, we're going to add in and put into place infrastructure and an open market in which insurance companies have to play in. Now, here's the thing, though. Insurance companies were guaranteed money for it. So Obamacare was awesome for insurance companies. They made tons of money from this. This was a boom for them. And same with the healthcare organizations. Healthcare prices went up. So healthcare prices went up, insurance premiums went up, and insurance companies and healthcare providers are making more money than ever. But insurers are not. So it allowed an open market and a way to mobilize and force insurance companies on. But in order to do that, the government just simply backed it. So it's a government paid program that's administered through the private market, but it's not your insurance. Kyle,
so you don't think that's going to have to happen anyway for Florida? I guess like when you guys say like someone can just move, I would argue like when you say someone can just move, I think Florida's already at that point where you can't just move. Like it's happened in parts of Louisiana that get flooded all the time. Like if you live in these places like that have been flooded multiple times, like you can't sell your house. Like you're not going to be able to, like whatever your mortgage is, you're not going to be able to get out of it because nobody wants to pay for a place that has stupid high insurance and gets flooded all the time and hit with hurricanes all the time. So you're not going to be able to get out of your house. So people can't move. They're not going to be
should
able
they be allowed to go bankrupt, or should we have to burden those decisions?
And again, that's the question we need to ask or answer.
Yeah, I'm totally fine with it. The people making those choices that can't afford insurance and choosing to live there anyways, to then reap the consequences of those choices.
So AJ, if you're saying there's been a family living in the same house, multiple generations for 100 years, and all of a sudden everything's been good for 3 or 4 generations worth of people just passing the house down. And all of a sudden now their insurance is going up to astronomical levels that they can't afford. They're lower middle class and they can't sell their house because no one wants it. Like that, the government hasn't been, as an American government, we're not designed to help people in need like that. Like, I guess it's just like, where do you draw the line on that?
Oh, well, if we're going to do that, then how do you pick and choose now? So you're talking hurricanes. Is that just going to be applied to everyone everywhere? Fires, wildfires, landslides? Are we going to do it to flooding? It's just like all of a sudden I can live anywhere and the government's going to have to bail it out. So I'm going to build a huge, nice home in an area that I know is going to have a wildfire, right, and burn down. Insurance is too high, so I'm not going to pay for it. And I can now still live there, even though I technically shouldn't.
The government already does that. Like as far as the national flood insurance, there are places all up and down the coast that should not be there, that are constantly flooded, have erosion happening.
I know you're talking about expanding that to even more. That's
okay,
what
first of all, I'm not saying that this is what the solution should be. I'm saying what's the most likely thing that's going to happen based off a historic track record of how the government handles these things. And I just think, to Jay's point, if you look at the 2 scenarios of letting them fail or basically stepping in and bailing them all out, I think they're bailing them all out. And I'm saying, how is that going to happen? And I'm looking at it and saying, the way that this is going to happen is we need some sort of, it's either going to be like California was kind of an anomaly where we had all these wildfires and stuff, but it was mainly rich people, right? Like it was like when I say mainly, there was a good portion of rich people who, like, it's not ruining their lives. Like in Florida, there's still a lot of lower income, fixed income, like people who are living there who this is happening to. So I just think it's going to have a lot bigger spotlight of people and stories happening that, like, there has to be some like sweeping reform.
Kyle, I'm not thinking about fires here in California. I'm thinking about the people who just can't afford to live in California anymore because prices have gone up and the cost of living has gone up so much that they can't afford to live here anymore. And so they're moving to Tennessee, to Florida.
Yeah, but they can still sell their house.
That's true. They could sell their house.
In Florida, after this, like I was considered for years, and Jay will attest to that. We've been considering moving to Florida for years. It is off the list now. Like it is like we are not moving to Florida until something is figured out. Because like it is just like it makes no sense for anybody, if you have options, to move into Florida right now.
But what's going to get figured out, even if this is my point I made earlier, like even if it's all figured out and your insurance is something now that makes sense and it financially makes sense, your house is still going to get torn down and you're still going to have to spend the next 12 months rebuilding. Like, why would you want to live in a place where your house just gets built down and then, yeah, even if insurance builds it,
And if you know it's going to get demolished, why are we just saying that I'm going to go move and build a house somewhere that we know will be demolished? So I'm only going to do it if the government's going to pay.
Well, here's another thing to consider. What we're starting to see is a lot of houses that got destroyed and a lot of rental properties that got destroyed. The government coming back and saying, we're only going to let you rebuild if you rebuild the code. And rebuilding the code means basically not building any living spaces within X number of feet above sea level, depending on where exactly you are and how far inland you are and the expected storm surge.
Reworking the flood maps of what's a good place to build.
Yep. But the reality is, as an investor, I've looked at some of these properties. Can I buy this property? You hand me the land for free. The rebuild cost and the amount of rent I'm likely to get for that property doesn't justify basically you handing me the land for free. Because
it's like Detroit, Michigan, back in about a decade ago.
It's funny that we're talking about like the Siesta Key as Detroit, Michigan, but there are some analogies there. And so, I mean, here's the other thing: even if the government wants to subsidize it, I hate to make this sound so simple, but here's a way to think about the math. Historically, or as of the last few years, Floridian homeowners have paid about 1% of the value of their property in insurance, which means if an insurance claim to like pay the entire house, like the house got destroyed, happened every 100 years, the insurance company would break even because 1% a year, then you get all that money back after 100 years. So if that 100-year storm happened every 101 years, the insurance company made money. If it happened every 99 years, the insurance company lost money. Well, we're now seeing 100-year storms and 500-year storms happening every 5 or 10 or 15 or 20 years. And so literally for that math to work, instead of a homeowner paying 1% of their value of their house in insurance every year, if there's going to be a storm every 50 years that destroys their house, now you're paying 2%. Every 25 years, now you're paying 4%. And here's the thing. The storms are going to get worse. I mean, I'm sure we don't want to argue climate change on this.
Oh, you went there. I wanted to know which conspiracy theory we were going to go with. Was it climate change or storm seeding? Because I think the government also created Hurricane Milton.
But the reality is the air's getting warmer and the sea's getting warmer. I said 4 months ago that this was going to be the single worst hurricane season that Florida's seen in the last decade, because water temperatures were so high and air temperatures.
So it's your fault, Jay, because you said it was going to happen, then it happened. Good job.
Jay, you should wait. Jay, you should definitely get your editor to find that clip, and you should you should do the Gary Vee thing where you put half of the screen of you saying it, and then now another half saying, "Hey,
Hurricane Milton, just all the news articles."
I don't know if I said on this podcast,
Jay. That's what I think we're talking about here, though, too. Because I agree, these storms aren't going to go away; they're not going. So you have mass population moving there. Why? Because it's beautiful, awesome, good for you. That is a choice. Florida has doubled in size, and they're getting slammed with hurricanes, and then people are saying, I can't believe this happened. When I see people that say that and they're like, I can't believe this happened. I'm like, how could you not believe you? What do you mean? You're going to get hit by a hurricane every single few years. What do you mean you can't believe this happened? So like when I had to move up and we want to live in the hills, the government requires me to do all of this earthquake engineering, everything astronomically expensive. So a lot of people don't go move and live in the hills because they don't want to pay for it. Right. And so I think it's weird to me, though, that we say, but because you want to live somewhere and we know these bad things are going to happen, that if you can't, you should be able to live there and not have to afford.
I really feel like the similarities, I know it's a perverted way of looking, but the similarities between Florida and California are hilarious, because it's like, it's like coming to California, moving to California, and then complaining about the high taxes and the high cost of living and the high crime. It's like, that's what it is. Like, if you're going to move to California, that's what you get.
Yeah, but that wasn't the thought with Florida. Like, Jay, how long have you lived in Florida?
Just over 5 years.
So 5 years ago, when you moved to Florida, you were trying to convincing us to move to Florida. And what did you say to us? When we brought up, the hurricanes. Oh, you guys get hit with hurricanes. What did you say?
I said Sarasota doesn't get hit by hurricanes.
So my point is that 5 years ago, this whole like hurricane happening every year and hitting Florida, and like now 2 in Sarasota within a month, that wasn't happening. So like, yes, okay, yeah, I agree, AJ. Now, if someone's saying like, oh, like I'm like, why would you move there?
I could have told you that long before. It's Florida. It's a peninsula.
We haven't had a hit in 100 years. So
Okay, I have a property in Oklahoma. If I said, I am so shocked that a tornado hit my property in Oklahoma, and the city said, we haven't had a tornado in 100 years, that would be stupid for me to say because it's Oklahoma.
Are you calling Jay stupid?
that's okay. No, my wife says that AJ can say it too.
No, I said it'd be stupid for me to say, which you wouldn't.
I do want to point out one thing though. And I thought Kyle's analogy earlier between health insurance and property insurance was a perfect analogy. The argument can be that maybe one, stop making that face, Mauricio. The argument could be that one, is more important than the other. You could make that argument. But the reality is it's a great analogy. And when AJ just said, how ridiculous is it that somebody would say, like, I want to live in on the coast of Florida, but I also want you to subsidize my insurance. Is that any more ridiculous than the fact that somebody goes out and like drinks a 64 ounce Coke from 7-Eleven and then says, I want the government to subsidize my health insurance? I mean,
I completely agree. It's totally stupid and ridiculous. And that's why Obamacare was a joke. I'm totally on board and agree with you.
Yeah, but the problem is I remember a decade ago when New York was going to pass some laws around not being able to serve certain types of food and drink because they were too unhealthy. And people were up in arms that this was government overreach. It was socialism. It was communism. It was basically whatever, like the government telling us what we can and can't eat. And then 10 years later, it's, you better subsidize my health insurance regardless of what I eat. And so it's the same thing here. It's a good analogy. It's people moving into houses on the coast of Florida saying, don't tell me where I can live. Oh, but you also have to subsidize my insurance. Yeah, it's ridiculous.
Exactly. They shouldn't do it. They should go bankrupt. If they can't afford insurance and they get hit with a hurricane and they can't rebuild, they should go bankrupt. That's what happens if I get hit by a fire.
My point, AJ, is there's a difference in what we believe should happen. Just like, do we believe that people who choose to live unhealthy lifestyles should be paying the same health insurance costs as we do? Versus like what is actually going to happen. And I guess my point is that I don't think the government's just going to leave them hanging. So what are they going to do? And this is, I was going to just kind of sit here and act like, oh, this was my idea, the whole Obamacare and thing. But it was literally October 11th, the SSRN released an entire study and paper on Obamacare for homeowners. So if you want to go check that out, SSRN has a paper on it. Okay, top 10. Should we just keep with this, though, for the top 10, talking about home insurance? Because I thought it was super interesting just to look at Florida and how if you look at the top 10 most expensive home insurance cities, guess how many in the top 10 are from Florida?
First of all, that assumes I can even name 10 cities in Florida.
3, 4?
6. They're actually a lot of them are kind of all in around together. But I'll ask Jay if he knows this. So the number one most expensive is Hialeah.
Oh, Hialeah. Yeah, it's basically Miami.
Yeah, so Hialeah is number one and Miami is number two. So I was like, and then Fort Lauderdale's number 3. So that's basically like almost the same MSA. But so this was crazy to me. So the study was based off of a $300,000 mortgage or $300,000 policy. So how much do you think it costs in the Miami MSA area for the annual premium?
$18,000.
Any other guesses?
Yeah, I mean, if the average is 11 and that's on the high end, I would say, I'd say $17,999.
You guys are cheating. You definitely read this before. 17,600 was the high. Miami.
Nice. We're done with that chicken dinner.
Mauricio was just copying off of me.
Then number 4 is Hollywood, Florida. Number 5 is West Palm Beach. Number 6 is Port St. Lucie. And then it gets into LA, Kenner, LA, or sorry, LA, Louisiana, by LA. Kenner, Louisiana.
Do you think those numbers will be updated after these two hurricanes? Since it's a little bit on the West Coast.
I expect premiums to go up 25 to 30% over the next 6 months. There's my
Yeah,
prediction.
so this article was actually from the month before the hurricanes. So this is 2 months old. And it was only talking about the annual premiums for 2023. It has projected annual premiums, but not a lot changed as far as for 2024 for projections, but that probably changed quite a bit. More or less, we're Florida, Louisiana, and then randomly Ocean Springs, Missouri. I don't know what goes on there, but yeah. So that's your top 10. Okay, I got a would you rather for you guys, and I'm going to throw out a hypothetical for a would you rather here. So hypothetically, if there was someone online who relentlessly posts on every single real estate YouTube video that discusses cap rates and says that the hosts don't understand how cap rates work, would you rather A, ignore him because he's just a troll at this point that he's posted on so many videos about cap rates, B, debate him and just to prove that you're right, or C, troll him back and just continuously say that he should keep studying, and when he studies more, he will eventually understand how cap rates work? So Mauricio, I'll ask you, out of those examples,
And should you thank him for being a loyal listener as well?
Mauricio, of those answers, how would you handle someone who is relentlessly posting on cap rate videos saying that the hosts don't understand how they work?
I would ignore. I mean, you can't. I mean, at some point, when you become as popular as when you become an influencer and you become popular, I'm talking about AJ specifically. He knows. You just got to ignore. There's so many crazies out there that just post. They don't have anything better to do, and they just start posting stuff that you just got to ignore them. You got to feel sorry. You got to have grace. You got to appreciate them, but you got to move on.
AJ, do you agree? Is that how you would handle this?
I made a video 2 years ago about cap rates, and some dude got on there and literally said, "You don't know anything about cap rates." Blah,
I'd be
blah,
willing
blah.
to bet it's the same guy.
It's probably the same dude. I didn't let it slide.
So what did you do?
Probably said a lot of things.
So basically you had B where you debated him and went back at him and proved that you were right.
Yes, it was a weak moment. Mauricio is correct, but it was a weak moment. And not that I'm sorry about it.
But this was a couple years ago. AJ, this was a couple years ago when you were not.
Yes, this was a few years ago.
He didn't have Ernie in the back of his display.
That's right.
Actually, but I think wait. I think when this was happening, AJ was in the hospital and he didn't quite have his faculties together, and he was just going off.
Jay, in this completely hypothetical, didn't actually happen in real life scenario, how would you handle this situation?
If hypothetically this was somebody I've been dealing with for 15 years, used to be a troll on Bigger Pockets, and has done this across, from what I can tell, is dozens or hundreds of podcasters over the years. Hypothetically, I would probably troll that person back and make fun of him, and then thank him for being a loyal listener to the show, and encourage him to keep studying and learning, and maybe one day he'll get it.
And also thank for the algorithm, because it does help the algorithm. So really, there's a benefit there.
That's why hypothetically Jay would do it. Like you shouldn't go back and check our previous episode and check that out, because it's a hypothetical. It didn't actually happen. I just thought of this. I'm going to throw a D on there, and the option D.
You're going to throw a D on there for episode 69?
Yeah, throw a D on it. The option D is invite him on the show and get his perspective, and then one of us can debate him, and we'll see how that goes.
Hypothetically, I suspect he's an old crotchety appraiser who lives in Hawaii named Bob. Hypothetically, and he's never actually been on camera before. He just trolls behind the scenes. Hypothetically.
Well, I'm just throwing it out there. So Bob from Hawaii, if he hypothetically was listening, I think it'd be great to have Jay debate him on cap rates. I would moderate it, completely impartial moderator. If we want Bob to get this, all we have to do historically is just put the name cap rate in our in the title of the episode.
true.
Even though there's nothing about cap rates in here, we just put it on there and he will listen to the episode. So cap rate, and see if the algorithm picks that up. AJ, you got anything to plug?
You know what? I'm going to plug our cap rate video, and I'm also going to plug Bob. So,
We're all going to plug Bob. Mauricio, what do you got?
If you want to know the tax implications of both candidates that are running for president, Real Estate Syndicate Alive next Tuesday, I've got Amanda Hahn doing a breakdown. So just go to realestatesyndicatelive.com if you want to check that out and join us live.
At some point, I'll get invited on that show. Jay, what do you got for us?
I was going to plug a book that was just released by a buddy of mine, Gary Lipsky. I came in the mail today, and I was hoping Mauricio, I forgot to bring it again. I have no internet at home, so I'm at a friend's house. But there it is. Invest Smart, Spotting Red Flags in Real Estate Syndications. Both Mauricio and I have a whatchamacallit in that book, a blurb in the book. And so I'm going to plug Gary's book. Thanks for sending me a copy, Gary.
Cool. Well, as always, I'm going to plug my wife, Badash Investor, on Instagram. Check her out, Badash Investor on YouTube. If you go there, she might still have some videos and posts up about our time in Cancun with all of our friends, except AJ. So you can go check all those out, see all the shenanigans we got into, surviving hurricanes and stuff, and we had a lot of fun. So check that out, Badash Investor.
And special thanks to your mom, Kyle.
In honor of episode 69. Yes.
Shout out to my mom who listens to every episode.
Hopefully not to the end.
And AJ was actually very disappointed in you last time for implying that my hometown was in the middle of nowhere. We grew up in a town that had 300,000 people. We have multiple Walmarts. It's a very mid-sized town. Thank you very much. All right. Well, my drink is gone. I'm gonna go hit the head. So, what do you do? Hey, did you just get your Five Guys dinner delivered right now?
maybe.
They DoorDash right to your
Are you not part of the challenge? Are you not part of the fitness challenge 2.0?
Does it look like I am with my milkshake here?
I love how he has a fountain drink like dispenser in his office, literally right outside the podcast studio, but he still gets the combo delivered from Five Guys to his house for the drink.
My fountain drink machine doesn't have milkshakes. Oh, dude, that's a good idea.
Oh, milkshake machine. Alex. All right. Well, my drink's gone, even though AJ's is just beginning. I'm going to go hit the head. I will see you next Tuesday.
See you guys.